Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So 169, if the market expires by November, the market goes down, I'm still going to have, if it happens the third week of October, I'm still going to have time on my side. We're still going to have premium built in there. Not the greatest chance of profiting, but I know that in the next 2 weeks, if the market is here or doesn't move much, then I'm not going to lose a whole lot of time value left on that put option. So I might just diversify a bit, do a couple, in the meantime, some vertical bear put spreads, as well as maybe some outright directional puts that are fairly out of the money on those, so that I can participate in a downside action move. And then I can at least participate with the market in different types of environment, whether the market is going to move sharply lower or whether the market just corrects just around that 50% handle. So if on a Fibonacci ratio area we correct at just about that 50% level, at least we were still, and if someone is anywhere in their in the realm of reality expecting the market to pull back and still be bullish, maybe we hold only at the 133, this old peak. Old resistance becomes new support. So, still it's a 300-point decline, and I think both strategies would profit in the next 21 days. So if I'm looking for a reversal in the next 21 days, this is exactly the types of strategy or thinking that I can start to employ some risk capital in, and then I have time on my side that if the trade doesn't mature, I'm not going to have all my money at risk, unless, of course, the market explodes straight through the roof, and then I have to start doing some position adjustments like LMO RFN orders, and that stands, it's floor talk for let me out right fricking now. And that's part of what I devise how I trade in different markets. I look for an opportunity. I say, okay, how much risk capital? If the whole thing explodes in my face, and the European Central Bank decides to raise rates, so there's a better rate of return. We're going to see an exodus of money out of the U.S. and into Europe. So, what would be the catalyst that would create this trade from not working for me? And I have to say, okay, let's think this through. Anything's possible in this crazy world, but odds favor the fact that, as we go, they go. And if our economy is still not, on solid footing, or let's say our economy is recovering better and equity prices are gaining and there's a better value here, then perhaps we will see a dollar rebound. That's another possibility. All I know is that in the short term, if I pay attention to the seasonal analysis and the technical analysis, I have a better way of maybe fighting and bucking the headline fundamental news, which has caused a lot of havoc and created a lot of bad trades for a lot of individuals this year. In fact, if you traded the headline news, just think about it. In January, we're off to the races. Everything was great. In February, the market was crashing. We're having another financial disaster. Then the market rallies again, and no one could see this one coming. We went from almost by late April, the stock market was up almost 9% year to date. The Russell, the small cap index, the Russell 2000 was up nearly 20% by April 26, year to date gains. That's amazing. And all of a sudden, poof, we're down by midsummer. We're negative 9% in the S&Ps year to date, which is pretty bizarre because we've just moved in the last 3 weeks over 1,000 Dow points. And we've gone from the S&Ps from approximately that 1037 to today's high, or even near this 1050 level that we're trading at in the S&Ps. If you think about it, folks, we're now up 4% year-to-date gain. Just 3.5 weeks, we were going for a double-dip recession, and most of the talking heads in the media were proclaiming a double-dip recession. So I substantiate my statement. If you traded the markets based on headline news, you're either long bonds and not in stocks, or you're in cash sitting on the sidelines. Either way, trading headline news may have cost you a lot of trading opportunities this year. So I can't say to you, is the euro currency, is this a guaranteed win? Nothing's guaranteed in this world. All I could do is look at a high probability situation, let history be the guide to my future, and say, listen, there are some good strategies lining up. Now, let me employ some kind of an option strategy that would best suit my risk-reward parameters. Obviously, I would love to do a credit call spread, but there just isn't anything enough in there for me to maybe to collect in order to profit from. So it's not something that I'm looking at, especially with that much time left. And by looking at the October credit call spreads, there's not enough time to have any premium built for me to do any credit spread to collect enough premium to make the risk worth the reward. So therefore, I'm down to maybe selecting outright put options for this potential correction. And now I have to go and maybe do some longer term work, which I'm going to start doing with you for a second, and say, is this area, and if I can go over here, we're going to delete the drawings, or try to. There we go. And I'm going to do it in an opposite fashion, if you don't mind. I'm going to use the ISE's Euro FX index. So just as if we're looking for the euro currency in dollar term to the, and I'll show you that one more time. If we're looking for this to go down, the spot euro index, if we're looking for the spot euro index to go down, then we would be looking for the euro index, the FX index, to go up. And incidentally, it's at its predicted monthly support. And yes, last month it came close to its predicted monthly resistance. It traded off of it. Now we're coming to predicted support. So this market has some decent characteristics of not only respecting the monthly pivots, but also in the market itself respects its seasonal tendencies. So I'm going to go over here, and I'm going to go over to a weekly chart, and I'm going to go, you know, from the trough that we saw last year in November. Remember, even last year that we see the market, last year it just barely did rally. It was a muted rally, kind of went down first, saw a drawdown, you know, by in the 1st of September, went a little bit lower, came back up to close higher. This would be a positive reaction even last year. But on or about the last week of September, as you can see even last year, headed into that October time period, we did see a market decline. And here's the problem that I have with this last year, right? The market, there was not a lot of action for a reaction to occur. So we saw kind of a muted move in this. So this year, I think we've seen a bigger move, and I think that's why we're going to see a nice reversal in the market. Here's one of the things that I wanted to show you as well. From a standpoint that even if you're not looking at pivot analysis, there's a lot of people who are resigned to the fact, a lot of professional traders and hedge funds and people in the foreign currency community, they really adhere and respect and use the Fibonacci tool. And so let's take a look at the Fibonacci tool and see what from this last swing low, right? And let me get it clicked on. From that last swing low, oh, please work. I have to do it all over again. You know, I like it when plans come together. All right, one more time.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.